Hey everyone, this is Hunter Satterfield, the Chief Investment Officer and one of the partners of Cain Watters and Associates. As always, I am joined today by my fellow partner and the head of the CWA Investment Committee, Brian Bortz, and then also Brad Sanders, the Managing Director of Tectonic Advisors. This is your January update, market update. For the month of January, the S&P 500 was up 6.3%. Global stocks were up 7.4%. Domestic bonds were up 3.1%, and then global bonds were up 3.3%. So here we are joined today as we are iced in here in DFW in our homes. We're joining you here from our homes, and it looks very positive as the market did very, very well in January overall. We did have some sector-specific stuff. We saw a little bit of a surge, both in international and also some growth stuff within the market. And so, Brad, as always, I want to come over to you first to sort of talk through a little bit about what happened in January, what caused sort of the market to pop a little bit, and then what you and your team are looking at as far as any potential looming concerns that are out there.
Yeah, I think it's more of a carry forward on, we're getting economic data that's supportive of the themes that the market has kind of already priced in, which is that the Fed is going to start tapering down its rate increases and probably take a pause at the middle of the year. And we've seen it good inflation data, good economic data that feeds into inflation that suggests that the rate of inflation is going to continue to moderate pretty significantly through the first half of the year. The dollar weakening, which is why you got a big pop in international. And, the beaten down sectors from 2022 got a pretty big pop. We've had some earnings in tech that were not as bad as expected, I guess would be a good way to put it. That were still weaker, but kind of over the muted expectations that had been put forth, and so that kind of helped the bounce and the beaten down stuff from last year, and the market really just kind of took the ball and ran. I don't like to be a bucket of cold water at all, but I would just caution our clients and advisors alike that this is probably more of a rally during a bearish market period than it is a start to a new bull market. I look at a lot of historical stuff to kind of guide when I'm helping Cain Watters, and this market is following the .com blow up to a T. And after that initial surge down in 2000 leading into 2001, we had a big 20-30% rip and the internet stocks, and everybody got all excited only to see them drop another 50 to 60%. And while I don't think we're in for that necessarily that kind of a drop again, I do think that growth, is going to have a tough time this year. Inflation's still high, and really the main part of my concern is the consumer. The consumer, we bring this up a lot because people tend to forget. And it's easy for, I think, our client base to forget because everybody listening to this is probably in the upper percentiles of wealth in the United States. So we're able to digest inflation a lot better than the average American that has little to no savings and lives paycheck to paycheck. But 72% of annual GDP is consumer spending driven. Credit card debt keeps hitting new highs. Savings rates are declining. And we saw $1 trillion of consumer discretionary dollars go away in 2022. That's the worst drop since the dreaded 1932 comparison. Now, we're not dealing with deflation. We're dealing with inflation here. It's not the same backdrop as the Great Depression, but that's also not a comparison we should all be high-fiving over and getting super excited about a market when you have that kind of wealth, that kind of spending going away. So we think a weak consumer is going to show up probably in earnings, and the stuff that's the most vulnerable to earnings going lower are kind of the things that are bouncing to start this year. Technology, anything consumer discretionary, anything with a subscription model kind of deal. That's kind of stuff that a weak consumer is non-supportive of valuations. And I keep making the parallel, and I'll kick it over to Brian after this to .com. But if you look at the S&P 500 as of last week, the forward multiple on the S&P 500 is about 17 times earnings, down from in the 20s. If you take the top 6 stocks out, which are the big cap tech names, it's 13 times earnings. Okay. So those 6 companies are responsible for almost a 40% higher multiple in the market in this kind of an environment. We've said oftentimes the market is not the economy and vice versa, but you're going to have to see that kind of stuff right size in order to get any type of true multiple expansion. And with that kind of backdrop, the market is setting up, which I've mentioned, I think ad nauseum on this call. The market's set up to bifurcate like it did in 2001, where you might have a year where you have some tough index numbers, but you could see certain types of the parts of the market do really well relative to others. And the bond market was our highest conviction this year, and we've kicked off a great year there with the bond market up 3%. So a lot to like here, but let's not get ahead of our skis.
Yeah, thanks. That's a lot of good info. And Brian, as we wrap up, I'd like to come over to you to just sort of talk about bigger macro things for 2023. As we start the year here, what are you and the rest of us on the investment committee kind of thinking through and talking through as we look at client portfolios?
Yeah, thanks, Hunter. First, man, Brad, that's a lot of cold water that you threw on there, man. And I kind of agree with you. If you look at how the market reacted, up 5 to 6%, depending on how you look at it, I don't think we're going to have a 60 to 70% year. So I like the message of having everybody take a step back. There is a lot of really good news out there. GDP is trying to recover. Inflation is moving in the right direction. The Fed is slowing down interest rates. We're going to get another Fed decision today as we speak. We still have a really strong labor market, even though all the headlines show that these major tech companies are laying all these people off. Even if you look at the IMF, which is kind of the global version of the Fed, for lack of a better comparison, the IMF is raising its growth expectations for the year. So there's a lot of positives. But as Brad mentioned, the consumer's done. That $1 trillion that they did not spend last year is going to show up somewhere in reduced earnings. And there's going to be a lot of volatility this year. So I just caution everybody listening, let's enjoy a really good month. Let's stick to our plan. And really, that's what we're doing on the investment committee. On the investment committee, we're trying to stay consistent. And I believe that we're going to have a good year, but I also believe it's going to be crazy volatile. So everybody just be very patient.
Yeah, good info, guys, on quite the month. As Brian said, we've got a Fed decision today that will certainly impact things in the market going forward. So we'll be back in front of you just in about 30 days or so with the results of February. As always, feel free to access any of our content that's out there and previous messages to look back on last year's crazy year as well. So thank you as always, and we will see you at the end of February.